Look at this map. There's a 21-mile wide strip of water sitting between Iran and Oman called the Strait of Hormuz. And right now, that little squiggle on the map is single-handedly holding the entire global economy hostage in a way we haven't seen since the 1970s. Because here's the thing, about 20% of the world's oil and roughly a third of all seaborne crude flows through this one narrow waterway every single day. So when Iran decided to shut it down, oil didn't just go up, it exploded. Brent crude is now sitting at $105 a barrel, which is up nearly 60% from where it started the year. And in case you were wondering, your gas pump has already done the math. But that's not the weirdest part. The weirdest part is that the stock market has just kind of shrugged. Like the S&P is still hovering near record highs, the Magnificent Seven is still partying, and Nvidia is still being valued like it personally invented electricity. So either A, investors are being incredibly chill about a literal war, disrupting a fifth of the global oil supply, or B, we're all about to learn a very expensive lesson about lag effects. And spoiler, it's usually B. So today we're going to break down what's actually happening because this isn't just another oil headline. It's a slow-motion stagflation setup, and most people aren't paying attention. Let me give you a quick history lesson, because this isn't the first time the world has watched oil-producing countries flex a vital choke point. October 1973. OPEC announces an oil embargo against the United States in retaliation for supporting Israel during the Yom Kippur War. Oil prices quadrupled in less than 6 months. Gas lines stretched for blocks. There were literal odd-even license plate rationing days. And the stock market? Well, between 1973 and 1974, the S&P 500 dropped 50%, marking the worst bear market since the Great Depression. Inflation, which was already uncomfortably high, surged to over 11%. Unemployment doubled. And the market didn't fully recover for nearly a decade. It was the textbook definition of stagflation. Rising prices, slowing growth, and absolutely zero good options for the Federal Reserve. Because here's the cruel irony with energy shocks. They're inflationary, which usually means the Fed needs to hike rates, but they're also recessionary, which usually means the Fed needs to cut rates. So the Fed just sits there frozen like Dave staring at his Tesla calls after a Powell speech, and as legendary investor Stanley Druckenmiller once said, you don't get inflation without an oil shock. Well, congratulations everyone, we got the oil shock. Which brings us back to today. April CPI just came in at 3.8%, hotter than expected. PPI ran hot too. And here's the part that should keep you up at night. That data was released before the full impact of the oil shock could even work its way through the supply chain. So if you think the inflation numbers look uncomfortable now, just wait until the next two CPI prints. Because as one major airline CEO put it this week, the jet fuel crisis is about to hit airlines worse than COVID. Worse than COVID. The guy was running an airline through 2020 and is using that as the comparison. That's like saying a hangover is worse than getting hit by a bus. And the worst part is, even if the Strait of Hormuz reopens tomorrow, the damage is already baked in. Tankers leaving the Persian Gulf take roughly 6 to 8 weeks to reach ports in North America, Europe, and East Asia. So the supply gap we're seeing in shipping data right now isn't going to be fixed by a single diplomatic breakthrough. It's already priced into the next 3 months of fuel costs, which is why even oil traders who think this war ends soon don't expect prices to return to pre-war levels. The toothpaste isn't going back in the tube. But here's where it gets really uncomfortable. Because rising oil prices don't hurt everyone the same. And this is where we get into what economists are calling the K-shape, which sounds like a yoga pose, but is actually one of the most dangerous economic patterns you can run into. Here's how the K-shape works. When energy prices spike, if you're a household earning $300,000 a year, $5 gas is mildly annoying. It's the kind of thing you complain about at dinner parties between sips of a $19 cocktail. But if you're a household earning $40,000 a year and you commute 40 miles each way to work, $5 gas isn't an inconvenience. It's your grocery budget. It's whether your kid does soccer this year. It's a real, immediate, choose which bill to skip kind of problem. And right now, that exact divide is showing up everywhere in the data. Retail sales rose 0.7% in April. Sounds fine, right? Except that's down from 1.9% the month before. And underneath that headline number, the spending mix is getting weird. Discretionary retail names like Kohl's, Sally Beauty, and Advance Auto Parts are down double digits this week alone. The SPDR Retail ETF is on track for its fourth straight weekly decline, which is its worst stretch since October of last year. Consumer sentiment just hit record lows. Meanwhile, luxury and high-end names are humming along like nothing's wrong. Hermes is doing fine. Ferrari is doing fine. The yacht people are doing extremely fine. So while the S&P 500 is at record highs, Main Street is quietly running out of money. Wall Street has rarely been further from Main Street than it is right now. And that's not me being dramatic. That's literally what every consumer-facing data point is screaming. Then on Friday, Trump and Xi wrapped up their Beijing summit. 2 days of meetings, cameras rolling. Both sides talked about how productive things were. And then nothing. No deal. No major agreement. No breakthrough on tariffs. No coordinated response on Iran. Trump said there were fantastic deals and that a lot of different problems got resolved, but NBC News reported nothing of substance was actually announced. China did agree to buy some Boeing planes, but the initial order came in smaller than the 500 plane package investors had been expecting. So Boeing dropped 2.8%. The market spent a week pricing in a summit deal that never showed up, and then immediately remembered that oil is still at $105 and there's no exit strategy. The Dow dropped 537 points on Friday. NASDAQ down 1.54%. And then the unthinkable happened. The AI stocks that have been levitating for months finally took a hit. Nvidia down 4.4%, Micron down 6.6%, Intel down over 6%. Cerebras gave back 10% the day after its IPO pop. Now listen, one bad Friday isn't a crash, but it is a warning. Because here's something nobody in the AI trade likes to talk about. AI requires absurd amounts of energy. Like, a single ChatGPT query uses roughly 10 times the electricity of a Google search. Data centers are projected to consume up to 12% of total U.S. electricity by 2028, and the entire investment thesis behind the Magnificent Seven quietly assumes that energy is plentiful, cheap, and reliable. Energy is no longer cheap. Energy is no longer reliable. And if oil stays elevated, every single AI capex projection on Wall Street needs to be rewritten. So where does that leave us? Well, this is the part where most market commentators would tell you to do something dramatic, like sell everything and buy gold, or YOLO into oil futures and hope for the best. But the truth is, nobody actually knows how this plays out. Markets don't follow scripts, and if anyone tells you they know exactly what happens next, well, they're either lying, trying to sell you a course, or both. But here's what we do know. The setup right now has uncomfortable echoes of 1973, energy shock, hot inflation, a Fed that's run out of good options, a market priced for perfection while the underlying economy is showing real cracks, and a population where the top 20% feels great and the bottom 60% is quietly drowning. As Mark Twain reportedly said, history doesn't repeat itself, but it does rhyme. And right now, this rhyme is starting to sound a little too familiar. So watch the straight, watch the pump, watch your portfolio, in that order. Because in markets, the moments that matter most are usually the ones everyone is too busy to notice. And right now, while CNBC is debating Nvidia's next earnings call, and Reddit is arguing about whether Palantir is going to $500, there's a 21-mile wide strip of water in the Persian Gulf that's quietly rewriting the rules of the global economy. So drop your take in the comments. Do you think we're heading for a full 1970s repeat? Or do you think the market shrugs this off like it always does? I'll be reading through them.